Mike E sent us a couple questions about 10 minutes ago, 10 minutes ago. I didn't actually get a chance. My apologies, I didn't get a chance to put any slides together for this particular question from Mike, but it's a pretty standard and simple question. It's a great question, don't get me wrong. All right, but let's go ahead and start off. Mike's first question is related to the market sentiment tool. And you see here, after a couple days of strong runs based on some of the stimulus concepts, based on some of the promise of a new stimulus going forward in the market and other things that happen as well. I've seen a couple days, most stocks have been up, a couple of mines have been wavering, but hey, that's okay. In any case, the sell warning just triggered now on the market sentiment tool after the last few days of moving up. And Mike asks, I see the warning, but most of my positions are already with a covered call or a long collar, so it is not easy to sell. He asks, what is the best strategy? Okay, so let's delve into this very quickly. The market sentiment tool is a combination of 13 broad-based indicators that Ernie tested and developed over time. And he used probably about 40 or 50 to start off with. What he was looking for was what fences on which indicators really pointed towards consistently a change in the market from neutral to bearish, from neutral to bullish, from bullish to bearish, from bearish to bullish, and so forth. And you see we have all of the different fences set here for the 13 indicators. Put-call volume ratio went into bearish mode. That's across the entire market. The SPX number of days up is right about neutral, but going really close to bearish as well. SPX gap over the 20-day moving average, that's bearish. Percentage of stocks over their 20-day moving average, that fence went to bearish as well. Interestingly, the VIX is bullish. It's been declining a little bit, so it's entered into slightly bullish territory. And the number of days that the SPX has been over the SMA 100 has gone bearish, as well as the MACD gap on the SPX because of the last 2 days of movement. So we see a sell warning. Now, we're going to go into overall sentiment history. It pulls up this graph for us, which shows when the declines happened and then when the bullish triggers came in. That's in the green down here, and the red is with the bearish signals. And we just have one sell warning right now, Mike. Okay, it's just the first day it triggered. So when I see a sell warning by itself on the first day, if I feel I'm overexposed into particular positions, I may consider planning to adjust, but I'm not at the adjustment period right now. Whether I'm in married puts, whether I'm in my bull put credit spreads, covered calls, you'd mentioned long collars, I'm not overly worried about those positions yet. It's in this time frame when we see several sell warnings in a row, okay, and then we start to see the bearish sells pop up also. The last major one here, when 826, I think it was, yeah, it went up for a couple days after that, and then it crashed really hard back down. It went from about 3,600 to, or 3,500, 3,580, I think was the height. But once you start to see 3 or 4 bearish sells in a row, 2 or 3 bearish sells in a row after several sell warnings, now it's when you might want to consider, is your covered call deep enough in the money with protection? Do you maybe want to adjust your long collar? Do you maybe want to take some of the covered calls off, buying to close the call, selling to close the stock, if your liquidation value is still profitable at this time? Depending on how far you have to go to expiration. Right now with that one sell warning, if I have options coming up next week for the October 16th expiration, I'm likely not in panic mode right now to make any adjustments in that case. If it goes back to neutral on Monday, if there's a little bit of easing, market pulls back maybe 0.5% or 1%, that's just in the noise. It might pull off of that sell warning, we'll go back to neutral, and that might be okay. So it's best not to over panic on one sell warning that comes up. Know that it's there. Be prepared for what you may have to do, Mike. But in this case, when I start seeing more of these, 3 or 4 of these in a row, that's when I might start actively adjusting my positions. Personally, for me with the married puts, that might mean selling a call if I feel we're at a peak right now, if I don't already have a call open in the married put, or selling a covered call. If I'm in a long collar, I might just leave it alone, depending on where the position is and how it's been working out for me, I may liquidate out of the position if I'm at a profit and worried about the market turning. I might scroll back some of my bull put spreads, close the ones that maybe are at least already at a profit, a reasonable profit, say 50 to 60%. And if I have long calls open, I may consider protecting them with a put or just getting out of them right now if I have a reasonable profit, an expected profit on the position. What I won't do right now with just one sell warning at all, Mike, is I'm not going to go start buying puts. I'm not going to start going into ratio bearish back spreads or things of that nature. It's not definitive enough yet. Okay, we haven't seen a few sell warnings in a row, and we haven't gone to that bearish sell yet. So I'm not overly concerned right now. We know the market can fluctuate in any day based on the news that comes out, especially over the weekend. So in that case, I have to be wary of that as well, and know what plans that I should make on that position. Okay, so let me go back to here. And, I scrolled back down to here. I went to August 25th and go further back here. I'm sorry, the reason I'm bringing this up is that Doug says, my overall market history, I believe you're talking about this here, only goes back to July 8th. This is Doug's question, 2020. How can I get the full list? Although this is on a trial, the webinar account that we're using on a trial here, Doug, I had the programmers expand it as though I was on a trial to the historical suite of tools that offers all of the data so that we could go back and see more of the data if necessary during the webinars. This is not my actual account. This is just the webinar account that we use. For that reason, that's why I have more history available, because my account, the webinar account, is technically on the historical. So if you wanted to go back further for the various market data that's shown here, that I have on my graph, and you could actually, I believe, go back even further than that in some cases, you might want to consider upgrading to the historical level of service if you're just on the 20-minute delayed now. And that's why you're seeing more data on this account than you might on yours as well. All right, so Mike, that's my general answer to the market sentiment tool. There are other presentations available, of course, if you go into the free webinars section. We have a look at the market sentiment tool. We look at some of the 13 indicators there, and I believe we talk about the new graph and also some other ideas. If I'm not mistaken, it's either under options concepts. I thought there was another recent one here. Maybe it was, yeah, it's not here, so it might be in the requested topics section. Let me go back, but there's a webinar done recently too. Market sentiment tool, top fundamental criteria, and more. That's a short one. And then, of course, on YouTube, if you just go to our YouTube channel, you can search for market sentiment, and you'll see some recent discussions that we've had on the market sentiment tool, some of the criteria and some of the management we might consider in different strategies. Real quick here, just going to go to subscription info for Doug while we're on this right here. So Doug's question was related to that history, but here, we're going to review the subscription service real quick. Doug says that he's stuck on 20-minute delays if he's a registered rep. See the email later if they can change the history. The history shouldn't affect it. Go upgrading the history. So the 20-minute delayed is $65 per month. The historical service is $100 per month, but doesn't need any of the pro forms or approval or come with any of the extra costs if you went to real time. That's the issue if you're a registered rep. The history should not affect that in one. It affects, I know, it affects the subscription price, Doug, of course, but you shouldn't have to go through any of the issues. Just upgrading to the historical, keep the delayed, and then you'll get the historical level of service. We can change that for you at any time, no problem. Next question is from William A., who's joined us regularly on our Friday presentations, of course, and asks questions. Last couple of weeks, been asking questions about the market sentiment tool, and he has another one for us as well. And we covered the market. Whoa, we changed. How about that? I'm sorry. So, Mike, earlier on, we hadn't changed over yet, but we did go to Bearish Sell. Let's see what changed from the beginning of this presentation. I'm going to crop this little 2-minute section we're going to do here over there. So I think this is the one we were teetering on, right? The put call volume went to bearish. SPX number of days up went to bearish. SPX gap over the SMA 20. Earlier we were looking at these. The VIX moved away from bullish. It was hovering right at neutral, but it did sort of move away from bullish. Our top 5, and they're not ordered by top 5. I shouldn't say it that way. This is not most beneficial indicator number 1, number 2, number 3, number 4. They're not arranged that way. But anyway, the first 5 listed have all gone bearish. SPX days with the SMA 100 is bearish. I think we saw that, and the MACD gap was also bearish as well. So two of these other ones triggered. I think it was a new stock high and low, if I'm not mistaken, since what we talked about at 4:30 this morning. We have now moved, ta-da, from the sell warning to the bearish sell. That was the first part of Mike's question earlier. When he saw the sell warning, what should he do with his covered calls, long collars? I said, now is not the time of morning. I usually wait to see 2 or 3 of these bearish sells in a row. And we got it today, didn't we? Because I forgot, it always updates at around 5:10 p.m. when the history is downloaded and updated into the tables. So that was from Mike earlier. We did go to a bearish sell, but again, I still look for 2 to 3 days in a row before I start panic mode. William's question is, good afternoon. The market sentiment indicators seem to give a neutral signal for most of September, yet the SPI had 4 down weeks in a row, lower highs, lower lows from 8/31 to 9/21. The last 2 weeks have been higher highs and higher lows. The MSI has almost mostly been neutral. When you have fairly extended period of mostly neutral signals, do you alter any of your favorite strategies or employ any other specific strategies? Okay, so this wasn't directly related to this, but it is, and the answer is no. Okay. And you had said that for most of September, we were in a neutral section, but you saw 4 weeks of down days. And to me, the 4 weeks of down days was still coming off of this. Okay. Just because this went to neutral when it started to ease off a little bit, I didn't think it was done. We dropped down that first week, the first section here. The first week was declining a little bit. Yeah. From 3,580 down to 3,3. We talked about that at the beginning. This is when we talked about how I was adjusting positions, planning for that. Okay, so we fell. We're in this range, the 333, 340. That's still related on September 11th, September 12th, 10th here. That's still related to the warnings that I saw 2 weeks ago in August. This is still part of that decline, even though that valve has been eased and we're neutral. Okay, so what do? We start moving back up a little bit. I mean, we're going up. Okay, sorry, let's start here. We go up 40 points total. We go up another 20 points. We drop down 15. This is kind of in the noise. Drop down 30. Okay, drop down 40. Now it looks severe from here to here, but it's really not. It's kind of in the noise. And we get a little big drop up. Then we're right back up to where we were, right back up. We almost hit a buy, but it was too soon, right? It didn't stay in that fashion. So it didn't get pushed to that strong buy, very bullish buy, William. It stayed at just a light buy one day because of the easing off had come down as we expected, 32.36 here. It had dropped from where we were at 35.80 a couple weeks ago. And it was moving down, but I'm still in the mindset that that was from the warning in August. It might take 2 to 3 weeks to realize that downturn. Okay, then 925, 926, we start to move back up, and we saw that one light buy. So we go back into 33.80, 34, 33. See, now this is just noise here. This is 40 points, $4 up and down here on SPX, 40 points here, 34.19, 34.66. So in this time period, I did open 1 or 2 new married put positions. I can't remember. JD I opened, and AEM, which we just looked at, was somewhere in this near-term time frame. I joked last week. Yeah, okay. I joked last week that I could have told you that the market was really going to fall when it did that one day it went down, that Monday or Tuesday. Now, it wasn't 925, was it? Oh, no, not that day. I'm staring right at it here, but I'm not seeing it. Yeah, this day. I guess it was there. It was Monday to Tuesday, I believe. And I said, because, I opened a married put on this day on 10.5. So I could have told you the market was going to go down the next day. I mean, that's obvious. That's going to happen since I posted a new married put in Fusion. It's bound to happen. In that case, I'm still opening positions because we almost got into that buy range. I'm opening bullish positions. We almost got to that buy range. And yes, we were declining here, but what did that give me the opportunity to potentially do? No, I'm sorry. What that gave me the potential to do is to adjust the puts there. But you see, now they've come back. So AEM we were looking at, bought in at 83.75. That was on September 10th. Okay, that's when we were still going down, but I felt strong with this. But in the last last little bit of the downturn, it went down to about, I think, 76 or 75. And it's come back up to almost where I bought it. All right. And JD, I think this went down almost the same. I bought it at 83. That's the one. It was on 10.2. I bought it at 83.75. Could have told you the market was going to fall on 10.3. But in any case, I'm still happy with the protection, and the stock's rebounding now. It's moving back up in price. The put took a hit. Why? I've only been in it for 7 days. Why did a put take so much of a hit? Because we had been coming down, the volatility was fluctuating, and we're going into earnings. This also goes in that discussion we had last week about the implied volatility on the short-term calls. It's also affecting the long-term puts. And some of the implied volatility actually dropped out of this when the notion of turning back on the talks of the stimulus sort of helped the market a little bit, as well as some other things as well. And in that case, so I was still opening these positions. My bull puts still are way out of the money. We're out of the money at that time. I've had 2 and 3 successful cycles since after 1 week after the bearish sell. 3 cycles. I'm in the 3rd cycle. I apologize. I'm in the 3rd cycle. I didn't open new positions for 1 week when the bearish sells came out, but when the valve eased, we hit neutral, and the market sort of dropped down from that 35.80. A week later, it was down at 10 days later. A week later, it was down at 3,300, 3,200. I think it was still at 3,300. I did buy more bull puts following that approach, and 2 weeks later, they expired worthless. And then followed the cycle again, and then those expired worthless last week. Last week, if I'm not mistaken. So now I'm in a new cycle in that case. All right. But for this, with the conversation that we had before, I just look for the stocks to dictate. Let me go back. With the bull put credit spread, even if we're in those neutral markets, and as you mentioned, I'm seeing it fall, I knew we had the bearish sell, which is why I took a week to 10 days off when that bearish sell triggered, William. When those 3 in a row triggered, 2 or 3 in a row triggered on August 24th, was because I wanted to wait to see some of the easing before opening new bull puts. 10 to 12 days later, I opened that new married put on AEM because it had gone back to neutral. So I didn't do, what I'm saying to you is I didn't do bullish trades until I saw the easing. When I saw those 3 bearish sells in a row, I stopped new trades at this point, new bullish trades at this point, until we got some of that easing off. And there it is. Yeah, about when it dropped down to 33 and we were in neutral, that's when I started doing them again. Okay. And yeah, so it would have been, it was around that time. In any case, did I jump into more bullish strategies? Did I start buying calls? Did I start doing other strategies? No. That's what makes me kind of boring, William. I tend to stay with the 3 or 4 strategies I know, I develop trading plans for, and I have management techniques for the married puts, the bull puts, the calendar spreads. And occasionally, I'll get a little fun. I bought out of the money calls on GOOS, on semiconductor, and a couple of others. On semiconductor worked out really well, but that was, I'm going to be honest with you, that was dumb luck. They moved up 10% yesterday for other news not related to anything going on currently in the market, not even earnings, nothing along those lines. So as you can imagine, the stock wavering at around 21, 21.50. I was holding 23 calls. I think the stock closed today, or it hit 26.70 today, and I think it ended above 26 or just at 25.90. I haven't looked since 3:30. But anyway, I closed those yesterday. Those all worked out really good. But it was just a light gamble. It's a very, very small portion of money that I put into those 3 long calls in this case. All were profitable and just got out of them, didn't manage them. Now that I see this, might I start buying out of the money puts? I don't know. Okay, I'm not clear yet if I'm going to start doing it because I haven't seen the 2 or 3 in a row. If this starts popping up 2 or 3 in a row, so for example, if we go up again on Monday, you're going to see another bearish sell. And if it even stays stable from Monday to Tuesday, you're going to see another bearish sell. Once I see that come up, what might I do? I might buy an extra put on my married puts. I might close any bull puts I have open that are at a reasonable profit. I mean, 60, 70, 80% of what I expected to make in that case. Now, again, that doesn't mean that on Wednesday or Thursday, we're going to start seeing a decline if we see those 2 other bearish sells in a row. It means that we might still go up for 3 or 4 days. and then 2 weeks of easing off. But if by, and I want to say miracle, I know a lot of us have different ideas on this, but if Congress and everyone gets together and they do pass another stimulus by Thursday of next week, this is still going to show bearish, but the market's going to jump. You know that. We all know that. And the market's going to react to that easing and that stimulus benefit. Hopefully, we probably wouldn't see till December 1st, but in any case, that's not the point. The market's going to react on that news. And we'll still be in a strong bearish sell, but we'll be ramping up. We might go back above 35. We might go back to, where are we now? I just saw it and then I forgot. 35, easy. We might go to 36, 3,600 on SPX. That's a possibility. Is it going to pass next week? No, they're not even going to have their heads together next week. I'm just saying, if by some random chance they do pass something like that next week, we'll still be in bearish sell mode. Those things will still be screaming bearish sell. We'll be at 8 to 2, we'll be at 11 to 2 perhaps. And this could be rising up to 3,550, 3,600, 3,620. That's a possibility. I would be planning at that time to protect against the downturn, not necessarily to buy new positions, to enter into complex strategies or bearish strategies that don't have a trading plan for yet. I'm just speculating on profit. Sure, I might add more VIX calls. I might buy shares of UVXY if I see us jumping up to 3,550, 3,600 for whatever reason next week. That's true. But I have positions already open. I've got bull puts already open. I'm going to look to close at a profit when I see those 3 bearish signals in a row. We might even ease off. We might see a 3% drop on Monday, okay? And that would probably drop 2 or 3 of these bearish signals out. We might go back to neutral. That's a possibility. And you'd say, oh, well, the market sentiment did say a bearish sell and it's down 2 or 3%. Well, that's not really the drop it was referring to. We saw the drop of what, 10% in September that you referenced. It was a strong decline. And that's what you remember that Ernie and I had been saying. I'd been saying that Ernie and I have been saying that since August. When we see those 3 or 4 bearish sells in a row, when the market's peaking out the way it has, and 3 or 4 of those signals, 5 or 6 of those signals are going into bearish sell, and we start seeing the red bearish sells, we usually expect a 7 to 10% correction at that point. Okay. Now, I'm not saying there's any real math to it. It's just what we expect from what we've seen in the history, what I've tried to relate to you about the history, why I mentioned earlier to Mike when he asked the question that right now when we looked at it at 430, 432, we were just here. And I said, I should have said, I want to wait to see what this did for the next time. And sure enough, I should have realized this would have jumped up to a bearish sell just based on the movements we saw today. But again, I'm looking for a few of those in a row before I'm going to start doing adjustments. And my focus isn't going to be on entering new bearish positions, William, that are going to be profitable at this point. My focus is going to be, what do I need to do to the 5 or 6 Marion puts I have open, the 3 or 4 bull put credit spreads to 2 or 3 calendar spreads. I have to address all of that first before I just start throwing, I need to do a bear call credit spread now. I need to buy puts. I need to do ratio put spreads to take advantage of this downturn. I need to do broken wing butterflies to the negative side so I can profit huge on those positions as it falls. No, I've got to address the positions I have open right now first before anything else. So yes, I might buy out of the money puts on SPY. I might buy more shares of UVXY. I might buy VIX calls to take advantage of the spike if the prices are right. But I'm not moving my whole portfolio. I'm not closing all of my married puts. Because remember, those puts, a lot of them are out to February and January. I'm still bullish long-term on those, with taking into account 2 to 3 weeks we might see the market fall if we see 2 or 3 bearish sell indicators in a row, as we did on 8/24. And then roughly a month later, we're at the bottom. 4 weeks later, 3 weeks later, we're near that bottom, 32.81, 32.36, 32.46. That was the low there, 32.36, right? So it was a month after those were triggered. But remember, while those were being triggered, we're at 3.444. What happened? We still went up 4 or 5 days in a row, 6 days in a row, still looking good. This is the decline. This is when that decline started that we were looking at. And we had that drop down from 35.80 to 33.40. It's pretty decent. And we dropped all the way down, as you mentioned, that 8-9% to 32.61. 32.36, excuse me, from 35.80, right? So we're talking about a 350 drop from 35.80. That was about 10%. And that was related to the sell warnings, 3 in a row, 4 in a row, bearish sells that were triggered in August. That's what I was looking for. If I see 3 or 4 again, and we're back up to 35.10, I won't be surprised that the next, maybe not starting right away, but starting sometime, you know, October 20th, October 22nd, we might start another decline that might be 5 to 7%. But on Monday, if this goes back to neutral, if there's some easing off on Monday, just a 1 or 2 or maybe even 3% easing on SPX, NDX in the broad market, this will probably go back to neutral, and I won't worry about as the things I just mentioned, adding extra puts to the married puts, closing out the bull put credit spreads, the calendar spreads. I might not try to manage those into shorter term strangle positions. Long strangles, not the short strangles we talked about earlier, long strangles by adding another put there to either protect some of the gains I have in that diagonal spread, or if I'm at my profit target, I'll just get out of those for the time being. But I'm not going to just start buying into bearish positions yet, unless I start to see more of a bearish position. And then when we hit the bottom, I might open some new married puts. All right. So William says, I'm sorry. Thank you, Michael. Thorough answer. Always appreciated. So you would say the MSI is, oh, shoot, where'd it go? There it is. The market sentiment indicator is a leading indicator. Yeah. I've always said that, maybe not in the greatest of expressions. I think on most of our conversations, William, that we've had, that's why I always say, I'm sorry, let me go back to the home. That's why since August, since before August, since we last saw this in February, remember, or this came up in January. Is that the first time it came up? Let's see, can I go back that far? Oh yeah, there's those couple there in June too. But we only saw one bearish sell. There's our buys at the bottom in March. There we go. This one here. That's when they triggered 117. Now, there's a lot of volatility in the market. We knew what was going on in other countries. We knew what could potentially go on here. We're seeing in the news what's going on with China at this point, right? We haven't heard a lot about Europe having a breakout yet. God, it seems like 4 years ago, doesn't it? January 17th, 2020. But not related to that, the market itself was going on a tear. Remember January 2020? Oh, how nice that was. January 1st to February 20th. How nice of a market. Well, if you were bullish, how nice of a market that was. But this was a warning. It really was, because just as we saw, 7 of those indicators were going bearish. They'd reached the fences where only about another 1% of the time they continue beyond those levels for those individual indicators. And that was there. And then it did go back to neutral. But let's clear this up. And I'm going to clear that up. Maybe Mike, erase your drawing so people can see what you're doing. We're not too high. We're at 33.29 here, okay, on January 17th. And we kind of waver about, this is all noise, 33.20, 33.21, 33.25. That's noise. Ooh, 32.95, okay. 32.43, okay. All right, back up a little bit. So now we're waffling in this neutral position. I haven't really seen the decline yet that I was expecting. And we're going through February. We're staying neutral. 32s, 30. Okay, now we get some movement back up. I actually expected the sell warnings to trigger again around this time. I thought we hit 34 here. Maybe we didn't. Yeah, I think it was here, I thought. So around Valentine's Day, around February 14th, we had dropped down to those 3200s level, 32.43. I'm not sure if that was the entire move, right? Because we didn't move that much yet, but that looked like the low point, if I'm not mistaken, 32.48. And on February 14th, we're back up to 33.80. And we stay in this area, and then all of a sudden, whoa, what's starting to go on here? We started to see some declines. And then they moved to buy, but this just went back up a little bit, and then it just started to fall and fall and fall. Now, these very bullish buys are triggering, and they're holding, but it wasn't until right here, 4 in a row, that's when Ernie decided. It was March 20th when Ernie decided to start buying into January calls for 2021. He bought into the big stocks. Remember the video he did? It was posted on 322 or 323, the current market conditions and what to do next. He was buying calls in Apple, Microsoft, IBM, I believe, if I'm not mistaken. I was doing Home Depot, Clorox, Costco. I bought calls there because once we started to see this many very bullish buys in a row, especially 4 in a row, I waited a little bit longer than Ernie did. Actually, I was here. I was somewhere in this range. Missed a little bit of it, but that's all right. It still worked out very well. He got pretty much right at 320. Didn't guess the bottom right, but was damn closer than I was, more confident than I was in the bottom in that case. So that's what I mean, because now that we've seen these very bullish buys, what started to move up? Did it move up a couple weeks later? Yeah. Did it move up a couple weeks after that? Oh, yeah. Did it move up a month after that? Yep, kept going, kept stabilizing, kept moving. So, and then we got to the bearish sell warning again once we broke through to that higher levels. Okay. So yes, I've always kind of tried to impress that this is a leading indicator, that we're not saying that even if I get, and I kind of hinted at this, even if I get, if we go up on Monday, I'm sorry, and I get another bearish sell on on Monday on 10/12, and then I get another bearish sell on 10/13 because the market continued to go up. I'm not saying that the next day has to be a negative day. I'm not saying that. What I'm saying is that those bearish sells in a row, hitting off the tops of these indicators and pushing it to 7 to 8 to maybe even 9 bearish signals, that means sometimes in the next 2 to 3 weeks, I'm expecting a start of a reasonable decline. The trick of it is, William, is that as much as I've tried to study the timing on this, and you can see this more on the graph of sort of how long it takes in some situations, but when I see those red warnings enter, I'm planning for that decline. When I see the greens come in, I'm starting to look at new options to buy. It could be 2 weeks away. It could be 2 days away. The start. What do I not think is going to happen, William? I don't think on Monday we're going to open 10% down. I don't think if I see another 2 bearish signals on Monday or Tuesday, I mean the bearish sell, the strong bearish sell here, this bearish sell warning, I don't think if I see 2 more on Monday and Tuesday that I expect a 10% drop on Wednesday or a 5% drop on Wednesday and a 5% drop on Thursday. No, I'm expecting the market has to ease off at some point soon in that case. The valves have to be open to release the pressure. And then what's likely going to happen is that over time, you're going to have up and down days. You're going to have volatility because we're going to be in earnings season 2 and the election coming up and everything going on with the pandemic again. But I'd expect that just by the way these indicators point us to is that there could probably easily be another 5, 7, 8% correction with all of that factored in within the next 3 to 4 weeks from the day the second, third, or fourth bearish sell is triggered. That's what I'm planning on. That's what I'm planning for. And so again, am I jumping into bearish positions? Well, I leave cash aside in my portfolio, as we all do, to maybe enter new positions if my sentiment's changing. But I'm not wiping my portfolio clean. I'm not going to exit out. I think I already said this, but I'll say it again. I'm not going to exit out all of my married puts, all of my bull put credit spreads, all of my diagonal spreads, any long collars I have open, and immediately just do the reverse. Open bear calls, open calendar puts, open married calls, and open the other ones. What did I just say? Short collars. Okay. I'm not going to do that, because I'm going to manage what I have open first, that I'm still bullish long term on most of those married put positions. Yeah, I'm going to have to address the bull puts, but that's likely going to be why I'm going to be buying new SPY puts or VIX calls or shares of UVXY. I might adjust the calendar puts, absolutely. My long collars are pretty much already protected, so I'm not overly worried about those. That's another comment we had from Mike when his question, he's got covered calls and long collars. Well, when again, Mike, when we see 2 or 3 of those in the bearish sell warning, 2 or 3 bearish sells in a row, I should say, that's when you might want to consider, do you need to roll down your covered calls? Do you need to add a put to your covered calls for more protection for the decline? Do you need to exit the long collars if you have a profit? Maybe add an extra put to maybe profit on the downside. That's what you might want to consider. But right now, I'm going to wait to see what happens in the next couple of days. Okay? Because again, it's possible we could ease off and go back to neutral. That 4 of those that just went to bearish might go back to neutral if there's a subtle easing. We go back down to 33.60. Okay, so it'd be a 110-point drop, right? That's significant, but it's not disastrous. right? And that would bring us back down maybe to neutral. We'll check on that on Monday. We'll see what happens. See how well this holds up. All right, so that goes to the second part there for William's question, excuse me, related to that also. All right, well, ladies and gentlemen, it is 5:45 p.m. Eastern time. I do not see any other questions that came in, but please, if you have any last-minute questions, go ahead and send those in to us. Of course, while we're still here, I just want to remind everyone, if you are just getting started on your trial, make sure you take advantage of those 4 steps that are listed: the free quick start guide, flash tutorial, free webinar, free coaching session, and more. Let's see here. We talked about, we talked about the price to book for PM for Mike already. That was that as well. Okay. All right. Okay. So let's see here. I was going to, Kip says, really nice discussion on the market sentiment indicators. Have a great weekend. Kip, thank you. I hope you have a great weekend as well. I just want to remind everyone, of course, that, there we go. Today's material are my thoughts on your questions designed for educational purposes, increasing investing performance and options knowledge. Any stocks or options discussed today should not be taken as recommendations or direct trading suggestions. Options do involve risk and may not be suitable for all investors. If you haven't tested PowerOptions yet, we didn't get a chance to really go through a lot of the tools today. We didn't go into the search tool that much. I didn't take a look at the portfolio tool, but for about a minute. But again, if you're interested in using some of the analysis tools we have, or taking a look at our patented search tools and the different strategies, remember you can take a 14-day free trial at any time. Just go to PowerOp.com, put in your name and email address. No credit card or billing information is required. And you'll have 14-day free access to the search tools, research and analysis, the signature tools we looked at today with that volatility skew on Apple and AEM, Goose, I believe, as well. Portfolio tools for tracking and evaluating rollout opportunities, and of course, the various education we have in the webinars that we looked at a little bit today, and much, much more available on PowerOptions. As we showed a little bit a while ago there for Doug, the subscriptions start at $45 per month for the end-of-day data service. Data is only updated at the end of the day at around 4:45, 4:30 p.m. Eastern Time. The delayed service, 15 to 20-minute delayed data, is $65 per month. The delayed data plus the historical shouldn't affect any professional kind of registration or anything. That's $100 per month. So you have full use of the back testing tools, and view of the market sentiment. And then the real-time service, every time you run a search or refresh the page, you're getting the numbers and the calculations at that time. That's $120. And then everything, real-time API access. If you have a programmer or you're a programmer and you want to work and interact with some of the data tables, plus all the historicals, $160. You can cancel the subscription at any time. There's no contractual obligation. You can, of course, get those free coaching sessions we talked about, and you can also upgrade or downgrade at any time from the various subscriptions as well. Now, okay, so the other free stuff, we mentioned the webinars page, powerop.com/webinars.asp, listing of a variety of different educational topics, but of course, you can always go to YouTube. Find us on YouTube, use your PowerOptions. You can just enter the search there for covered calls. You'll see a wealth of knowledge, different topics, but a wealth of knowledge on any strategy. But covered calls, bull put credit spreads, market sentiment tool, for example. You'll see all the different presentations that we have there. Plus, you can also check out the blog or the Learning Center at PowerOp.com for more resources.